If you own SoFi stock, 2026 could truly change everything for you, and today we are going to break down exactly why SoFi could be setting up for a massive move toward $36, $45, and even a long-term $75 price target. This is not hype, this is a deep dive into the business, the numbers, the strategy, and the future catalysts that many investors are still underestimating. If you're holding SoFi or thinking about buying it, this video could completely reshape how you see this stock over the next few years. SoFi is no longer just a student loan refinancing company. That old narrative is outdated, and investors who still believe it are missing the bigger picture. SoFi Technologies has quietly transformed itself into a full-scale digital financial ecosystem. Banking, investing, credit cards, personal loans, business services, and even infrastructure through its technology platform are all now part of SoFi's core strategy. This isn't a single product fintech anymore. This is a vertically integrated financial platform designed for long-term growth. One of the biggest turning points for SoFi was obtaining its national bank charter. That single move changed everything. With a bank charter, SoFi no longer depends heavily on third-party banks to fund loans. This dramatically lowers its cost of capital, increases margins, and gives SoFi more control over its balance sheet. Lower funding costs mean higher profitability over time, and profitability is the key that unlocks higher valuations in the stock market. Now let's talk about growth, because growth is where SoFi really shines. SoFi has been adding millions of new members year after year, and what makes this growth powerful is that it's not one-dimensional. These members don't just sign up for one product. They often use multiple products across banking, investing, and lending. This cross-selling engine increases lifetime customer value and makes SoFi more resilient during economic slowdowns. SoFi's financial services segment, especially SoFi Money and SoFi Invest, is becoming a major driver of engagement. Direct deposit growth is one of the most important metrics to watch, and SoFi has been seeing strong increases in direct deposit users. Direct deposits mean sticky customers. Sticky customers mean predictable revenue. Predictable revenue is exactly what long-term investors want to see. Another underappreciated part of SoFi's business is its technology platform, often overlooked by retail investors. Through its acquisition of Galileo and other infrastructure services, SoFi provides back-end financial technology to other fintech companies. This is a business-to-business revenue stream that scales extremely well and carries attractive margins. As more fintechs and financial apps come online, demand for this infrastructure grows, and SoFi benefits without taking direct consumer credit risk. Let's address the elephant in the room: student loans. Many investors were worried about government student loan moratoriums hurting SoFi's business. But here's the reality: SoFi adapted. While student loan refinancing slowed, SoFi aggressively expanded personal loans, credit cards, and banking services. Now that student loan repayments have resumed, this segment is coming back online, adding yet another growth tailwind going into 2026. Profitability is where the story gets even more interesting. SoFi has been steadily improving its margins, cutting costs, and scaling revenue. The company has already demonstrated that it can generate adjusted profitability, and full GAAP profitability is becoming a realistic expectation as we move closer to 2026. Once SoFi consistently reports profits, the market's perception of this stock can change dramatically. Valuation matters, and this is where the $36, $45, and $75 price targets start to make sense. At lower multiples, SoFi has been treated like a risky fintech experiment. But if SoFi is re-rated as a profitable, high-growth digital bank, its valuation framework changes completely. Traditional banks trade at lower growth but higher stability. High-growth fintechs trade at premium multiples. SoFi sits at the intersection of both worlds. A $36 price target is achievable if SoFi continues its current growth trajectory, improves profitability, and the market assigns it a reasonable fintech bank hybrid multiple. This would not require extreme optimism, just consistent execution and stable macroeconomic conditions. A $45 price target comes into play if SoFi exceeds expectations on member growth, product adoption, and earnings leverage. If revenue growth remains strong while operating expenses grow more slowly, earnings could surprise to the upside. This is often when institutional investors step in more aggressively, pushing valuations higher. Now let's talk about the $75 price target, because this is where the long-term vision really matters. A $75 SoFi stock price would likely require a combination of sustained profitability, strong economic conditions, continued innovation, and SoFi becoming a dominant digital finance brand for younger generations. If SoFi becomes the primary financial hub for millions of users, similar to how major banks dominated previous generations, this level is not unrealistic over a multi-year horizon. Leadership is another critical factor. SoFi's CEO, Anthony Noto, brings a strong background in finance, technology, and execution. Leadership matters immensely in growth companies, and SoFi has shown disciplined decision-making under his direction. Strategic acquisitions, cost control, and long-term vision have all played a role in positioning SoFi for the future. Macroeconomic conditions will also play a role. Interest rates, employment trends, and consumer spending all impact financial companies. However, SoFi's diversified revenue streams help reduce reliance on any single macro factor. Whether rates go up or down, SoFi has levers to pull across lending, banking, and technology services. Risk is part of every investment, and SoFi is no exception. Credit risk, regulatory changes, and increased competition from both traditional banks and fintech startups are real challenges. But SoFi's integrated ecosystem gives it a competitive moat that many smaller fintechs lack. Scale matters, and SoFi is building it rapidly. What makes SoFi particularly compelling for long-term investors is the demographic shift. Younger generations prefer digital-first financial solutions. They want everything in one app. Banking, investing, borrowing, and budgeting all in one place. This trend plays directly into SoFi's strengths and positions it well for the next decade. If you already own SoFi stock, the key question is patience. Many of the biggest gains in growth stocks come after profitability becomes clear, not before. If you're constantly watching short-term price fluctuations, you may miss the bigger picture. 2026 could be the year when SoFi transitions from a speculative growth story into a proven financial powerhouse. If you're considering buying SoFi, understanding your time horizon is crucial. This is not a get-rich-quick trade. This is a multi-year growth story that depends on execution, discipline, and long-term trends in digital finance. The potential upside is significant, but it requires conviction and risk management. In the end, SoFi represents something much bigger than just a stock ticker. It represents the evolution of how people interact with money. If SoFi continues to execute on its vision, expand its ecosystem, and deliver consistent financial results, the price targets of $36, $45, and even $75 may not sound crazy at all in hindsight. So the real question is not whether SoFi will be volatile along the way, because it will be. The real question is whether you believe in the long-term transformation of finance and SoFi's ability to lead that change. If the answer is yes, then 2026 truly could change everything for SoFi investors.